Better System Trader, episode 23.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 23 and I'm your host, Andrew Swanscott. Have you ever developed a terrific looking backtest only to lose money trading it after going live? Have you ever had a trading idea but were unsure how to determine if it really had an edge? Do you ever find yourself struggling to think of new trading ideas? If you said yes to one or more of these questions, then the Strategy Factory workshop taught by World Cup trading champion Kevin Davey may be just what you need. During this one-day online class, followed by 4 months of one-on-one email support, you'll learn how to successfully develop multiple trading strategies, plus you'll also receive fully disclosed code for 3 profitable strategies that Kevin actually trades. The workshop sells out well in advance, so head to the show notes at bettersystemtrader.com/23 or the sponsors page on the Better System Trader website to find out more. I've completed the workshop and it's fantastic. Now on to the show. This week's guest is Michael Himmel. He's a founding partner, portfolio manager and director of AI research for Essex Asset Management. He has been actively trading and designing systems since the 1980s, managing the No.1 Global Macro Hedge fund in the world in 1999. He now uses large doses of AI and machine learning in his current practice. In this week's episode, we discuss artificial intelligence, the challenges and applications of AI in trading, criticisms of machine learning, event studies, and the importance of selecting datasets. He also shares insights from his trading journey, starting out as a runner for some of the biggest players in the 1980s, to managing the No.1 Global Macro Hedge fund, and to how he's using AI in his trading today. Even if you're not into AI and machine learning, the stories and insights he shares are invaluable. Anyway, let's get to it. I hope you enjoy this week's chat with Michael Himmel. Thanks for joining us today, Michael. Can we please start by giving us a little bit of background into who you are and what you're currently doing?
Right. Thank you, Andrew. First, let me say that I really appreciate your website and your blog. And I think that anybody that's interested in the art and science of trading would benefit from listening to your podcast and watching your website. So I wanted to start with that. I really do appreciate it. I'm grateful to be a guest on your show today.
Oh, thanks very much.
So starting off with my background, I've been in trading for over 30 years. If we're going to start the clock at 1985, I was about to go into law school and decided instead to go on to the New York Mercantile Exchange as a clerk for $200 a week as a runner. And that was during the period of time when the New York Mercantile Exchange was primarily platinum and palladium. There was very little energy futures trading going on. In fact, the West Texas Intermediate contract, which is now the superstar of the Merc, had just been introduced. It was barely trading at all. So at that time, crude oil was about $30 a barrel, $33 a barrel, I think. And platinum and palladium, as I said, were the biggest movers on the NYMEX. So in a normal day, I would say 95% of our volume with Shearson Lehman Brothers through the institutional order desk was for the metals. And then, as we all know, comes the great collapse of crude oil, 1985, 1986, when the Saudis decided, very similar to what they're doing today, that they wanted lower prices across the board. And we watched crude oil go from $33 a barrel to $9.75 a barrel in a very short period of time. And during that whole collapse, and the reason I bring it up is because that was when all of the large institutions finally decided that they really needed to use the energy futures contracts for hedging. So the volume exploded, the activity exploded. Anybody that could spell the word oil future suddenly had a good job. And I just was dumb luck. I would take luck over just about anything in trading. And so there I was. So I was right in the middle of the whole thing, and suddenly I had a job. They moved me up to the upstairs to the institutional order futures desk for Lehman Brothers. And from there, I basically was in the oil market for the next 15 years.
So what type of or style of trading were you doing back then?
Right. So in the beginning, I was just a mutt, right? I was just a runner on the Merc floor taking orders. When I went upstairs, I was also still just taking orders.
Okay.
But here's where it all begins, Andrew. This is where I first saw, in fact, the first commodity trader that I really saw in real life was Louis Bacon. And this is during the days of the very, very early trend followers and global macro commodity traders. So these were the gods to me, right? These are the people that I looked up to. And a lot of them later on are have been on your show, right? These are the people that I was following all along. So in the beginning, it was Larry Williams and Richard Dennis, Louis Bacon, Paul Tudor Jones, right? These were the guys that were just coming out in the 1980s to early 1990s and putting up enormous numbers trading futures. So I got to see them firsthand. In fact, one of my first jobs at Lehman Brothers was hand margining the Soros accounts there. And so I could see, of course, I didn't know what I was looking at, but I could see an enormous amount of trades going through and an enormous broad range of products that they were trading, things that I had no idea about before I looked at those margin reports.
So exposure to those guys must have really had an impact on you. What else did you learn by working or doing the orders for those guys?
I absolutely learned at the very beginning how clearly dispassionate and objective they were in everything they did, how scientific they were in everything that they did. And whereas it was very easy for me as a phone clerk or a floor clerk to get caught up in the passion of the thing, right? When the crude oil is collapsing and the volume spikes and everybody's screaming and yelling, to watch these guys be so calm and collected about what they were doing and so mathematical about what they were doing was a true inspiration for me. And that's when I first understood that I would rather be in their seat rather than be down on the floor. That's when I made my decision that I really wanted to get off of the floor and get up into a desk.
Okay, sure. So that's exactly what you did, I understand. So what happened from there?
From there, I went through a few years of oil futures broking, both in institutional futures contracts, derivatives, and physicals. And from there, I got my big break, I would say, in 1995. I was engaged by Sinochem, the Chinese national oil company, to be part of their oil trading desk in London. For me, that was a huge break, as I said. That was my big break. And that was the first time that anybody thought highly enough of me to ask me to be part of the trading team. I jumped on the opportunity. My wife and I moved over to London, and I quickly became an oil futures trader for them, mainly since that desk was responsible for all oil around the world. That meant Saudi, Libyan, Dubai, Brent, and WTI. I was primarily responsible for WTI and Brent, and I'm happy to say every single year I was profitable, and every single year that desk made record profits every single year. It was a great time. Yeah.
Well, that's impressive. So what style of trading were you doing at Sinochem?
For the most part, I personally, when it was speculative only, of course I had my own book and I had my own risk budget, it was mainly spread trading. I really, and then and even till this day, I prefer relative trades, relative value trades, and spread trades. So that's always been my comfort level. And at that point, it was extremely profitable for us to focus on, for example, the Brent WTI spread or the Brent Dubai spread. So we're buying Brent, selling Dubai, or vice versa, something like that. That always seemed to be the best.
So was that a systematic trading or was that discretionary?
In the very beginning, it was a little bit of mostly discretionary. And it was something that I was really trying to get away from, Andrew. And this is what brings me to sit here and talk to you today.
Yep.
My whole process, my whole experimentation, my whole evolution with trading has always been about getting away from discretion, getting away from human input, getting away from animal instincts, and getting to systematic, scientific, data-driven, and quantitative. And so during that period of time was really when I made my big transition from the beginning, from the first to the second. And the way I did that was by doing an enormous amount of research in artificial neural networks, which we'll talk about later in this interview. But the earliest adopters of AI, I think I was very, very close to being one of the first. I really was. I didn't make money at it, but I was there in principle and in philosophy.
Okay, so that was mid to late 90s when you were doing that
Yes.
initial AI research. Technology's come a long way since then. What were some of the challenges you found back in the 90s with that particular style of testing, I guess you could say?
Exactly. The beginning of artificial neural networks goes far back, much further back than the 1990s. But that was really about the first time that the intersection of the software and the hardware became available to let's say the uninitiated, right? I'm not a programmer. I'm not a data scientist. I don't build computers for a living. I was a trader who was looking to use these tools. In the mid 90s, late 90s was about the first time that a newbie like me could put these tools together and start to use them on some level. Okay. Of course, I have to say at this point, there were others in the world, Renaissance tech, for example, who were doing it on a very deep level and making very profitably too. But I was not there. Okay. I was not there. I was really on my own, and I was trying to teach myself how to program and how to use the neural networks on my own. And that's what I was doing when I was at Sinochem. I convinced them to buy me a RISC machine and one of the cutting edge artificial neural network programs at the time. And I started to assimilate and aggregate an enormous amount of data on both fundamentals of crude oil and also the price action of crude oil and also the derivative products, right? Meaning heating oil, gasoline, and all this stuff. And I put it all into my neural network, and I started crunching it. And I had to work till 8 or 9 every single night. So I figured, why not sit there running simulations and optimizations instead of just staring at the screen. And so as the months and years went by, what I found was that the earliest level, and again, this is sort of the first iteration of backpropagation neural networks, they couldn't solve the riddle that I was looking to solve, right? So in a very broad way, I learned a lot about how AI works, and I learned a lot about how to engage in a data science kind of experiment, but I couldn't find a way to trade profitably based on what I'd learned during that period of time. And this actually is what some of the greatest AI researchers term the great winter of AI. Between, say, 1997, 1998, and 2010, really was a lot of research continued in the world of artificial intelligence and neural networks and data science. But what hadn't happened is we hadn't had the confluence of the cloud computing and the processing speeds exploding, right? And the costs collapsing. Those three things together made data science and AI in the financial markets available to almost everybody by the year, let's say by the year 2012 or 13. And now today it's everywhere.
Yeah, sure. Okay, so before we jump to today, is there any other challenges or lessons that you learnt while you're working at Sinochem?
Absolutely, a ton. In the beginning, I would say, because we were in the institutional world, right? So, Andrew, like a lot of people that you interview here, and maybe a lot of listeners too, you're trying to make your living just by trading, right? And if you don't get up in the morning and you don't find something to trade, or you don't find a trend to pull on, you don't find a counter trend, or whatever it is that you're after, nothing happens. So being a hired gun is a different life for everybody. It sure has been for me. And what I learned a ton there, right? I learned first and foremost that we need to want whatever the market wants. Okay, that's one of my first rules that I've learned. That I can't tell you how many times I heard a very highly paid oil executive say, "Well, oil will never go below 40 because the marginal cost of production is 45 or something, and there goes trades 975." Right. So obviously, wanting what the market wants is the biggest lesson that I learned from that whole period of time. We can all rely upon our fundamentals. We can all rely upon the prior trend. But at the end of the day, wherever the market's going, that's what we have to be the most sensitive to. and we can either accept it or ignore it, but we can't deny it, right? So
Yeah.
if the market's going up, I can either be on the sidelines and watching it dispassionately, or I can be long, but I can't be short. Those are kind of the basics of it all. I know it sounds very pithy, but in fact, I think in the very early phases of learning and studying the trend followers, that's what they were deriving from the experience that many people don't really get, right? They don't really see it. It's not so clear.
Mm. Well said. So if we move on from Sinochem, obviously, well, you're not there anymore. So what happened? What did you do after Sinochem?
From Sinochem, for personal reasons, mainly that my wife said to me, we've been here 3 years on a 2-year stint. I'm going back to America. So we moved back to America, and I moved back to take a job with a small power trading company, trading electricity and natural gas and the feedstocks of the gas plants, for example. That group was really great, and it was a great experience because the electricity market in America had just been deregulated for the first time ever. So it was exciting, and it was entrepreneurial, and it was fun. However, within 6 months of moving back to America and working with this group called, and after 7 or 8 months of working for them, they owed me an enormous bonus, which they reneged on. They just flat out said, that's too much money and we're not paying it to you, even though I had a contract to do so. And I said, well, if you're not going to pay me what you owe me by contract, what you agreed to in the beginning, I will not come to work with you anymore. And I left. And so at that time, I called up a very good old friend of mine who had recently also moved back to the States from Geneva. And I said, well, we've been talking about starting a hedge fund between us for years, all the time that we lived in Europe together. And I've just quit my job because they reneged on a contract and they screwed me out of an enormous amount of money. I said, if I'm ever going to start a hedge fund, now's the time to do it. Are you in? And he said, sure. So my friend Jeff and I started Lambeth Capital in May or June of 1998. Literally 2 idiots and some friends and family money. That's it.
You mentioned that there was a bit of a winter of AI. So did you continue doing your AI testing throughout this time as well?
I did, Andrew. That's great that you asked. I did, but mainly what it took was the point of TradeStation easy language at that point, right? So I was looking for ways to systematize my investment and trading platform and my own ideas, and to back test them and to validate hypothesis using the computer, but not necessarily using artificial neural networks or fuzzy logic networks or chaos theory or any of the other sort of key concepts that were popular at that time. So what I did during the next phase and during the hedge fund phase was to use easy language and TradeStation to validate my hypotheses.
Right. So did you switch to a different style of trading during that time?
Yes, we did. First things first. When we first started the hedge fund, we were not a CTA. We became a CTA later. So I did later register with the CFTC, et cetera, and change the registration of the fund. But in the beginning, we were a global macro long short equity fund. So what we were trading mainly in 1998, 1999 was equities and foreign exchange, both of which we could trade without being registered with the CFTC. As it turns out, in 1998, we made about 50% return. And in 1999, we became the #1 global macro hedge fund in the world, and with 260% return or some crazy number like that. And at the end of the year, you know what, Andrew, all we did was we were long levered the tech stocks. Simple, right? I'm a trend follower. Jeff is a trend follower. That was the most explosive, most fun trend I can remember. We just happened to get on early in the year. And by the fourth quarter, it was just insane, right? I think we made 70% or so in the fourth quarter alone.
Wow.
And it was nuts. It was a crazy time. But again, one of the other things that I hope to say tonight is that a great money management scheme can make a fair system great. Okay, you can start out with a fair system, and you can be great if you have the right money management. And this is another thing that another theme that I constantly hear. For example, I listened to a Larry Williams interview the other day, and also Vince, right?
Yep.
They say the same thing over again. If you have the right money management, anything can be great. So we caught these phenomenal explosive tech stocks, right? And so now they're up 50%. Now they're up 100%. Now they're up 200%. What do we do? So obviously we didn't add more to them. I think maybe a Kelly criteria would have been adding and adding, but we didn't. Okay, we didn't. We understood that the risk was gaining on itself whether we did anything or not. And essentially what we did was we instituted a bunch of zero cost collars and trailing stops on our biggest winners. And in fact, we got carried out of a bunch of trades in March of 2000, right? 3 months later, March of 2000 was a really painful time. We had a horrible downdraft, but we had protected the vast majority of our gains. Almost 85 or 90% of the gains were protected by using this very simple money management technique. And as it turns out, even with our downdraft in March of 2000, we were still up in the year 2000, which was not an easy thing to do. I think we were up about 16 or 18% in that year too. So, hey, I've gotten off the topic here. I'm sorry. Go back.
No, that's okay. So, well, I think you answered it. You say you switched to a trend following model, which just happened to be the perfect, I guess, kind of model to have at that period of time.
Right.
So, what happened after that?
Right. So I'm not going to drag you through every single year, but the next big thing that happened was 2001, right? It's a year that nobody will ever forget. And as it turns out, going into 2001, all the trends in equities had already been broken. The Nasdaq was in a major bear trend. We didn't really feel like going short. There's a lot of reasons why, but we just didn't really get on board with the idea of getting short a whole bunch of stocks and riding it all down. So we were looking for other trends and other markets to play. By 2001, we'd already become a CTA. So we were trading crude oil. We were trading a lot of FX, especially a lot of FX. And so when 9/11 happened, in fact, again, luck and timing, not any deliberate prediction. We happened to be short the US dollar. And long Swiss francs, long, I don't know, euro or something like that. And so when in September of 2001, we made a pretty good return. I don't remember exactly what, maybe 3 or 4 or 5%. But in any event, we had a serious amount of survivor guilt. And we did end up the year plus, maybe plus 8 or 10%, something in that zone. I should say, by the way, that all the 7 years that we managed the hedge fund together, we never lost money. We never had a down year ever.
Wow.
And we compounded out around 28% or something like that after fees. It was great. It was a great run. But what happened then, and I don't want to drag this conversation too far into compliance, but from once September 11 happened, we were an offshore domiciled, an onshore domiciled hedge fund. We suddenly were overwhelmed with compliance. It was just incredible. Every single fee that we had encountered prior doubled, tripled, quadrupled. It was out of control. We had our offshore domicile was in the Cayman Islands. We used the largest hedge fund administrator in the planet at the time, extremely highly rated, one of the best auditors in the world at the time. And every single one of them said to us, we're going to have to quadruple your fees or we can't do business with you anymore. So we carried on for another year like that. By the way, I should say that we had never gained any traction with the institutional investors after putting up our 260% year for the very same reasons that me, 20 years later or whatever, 15 years later, I'm not doling out money to hedge funds that make 260% per year.
Yeah.
It's just way too radical, way too volatile for any institutional investor really to get involved in. So we really had to be happy with the amount of investors that we had at that time. We really did not pick up any big clients after that, even though we thought that we would. by the year 2003, my partner and very dear friend Jeff said, we've been at it almost 7 years. I haven't taken a vacation. I've had enough. I need a break. I need a break. So he retired at a very tender age. He's still a very dear friend of mine. I'm hoping to bring him back into our group soon, out of retirement. But at that point, I was left with the hedge fund all on my own. And I chose, after 1 year of managing it with, starts and stops, basically, to break it up, disaggregate it, send everybody their money back, and go to a separate accounts platform. The reason I tell you that whole story is because I'm on the separate accounts model till this day because of that.
So it sounds like we're moving to where you're working now. Can you give us a bit of background into that?
Right now, I'm a partner and founding member of Essex Asset Management. We are a relatively small registered investment advisor based in Vero Beach, Florida. We have about $150 million under active management or oversight. We are mainly categorized as a multifamily office. We focus on multi-generational wealth planning, investment management, and transfer, right? So once we made the transition from Michael the trader at Sinachem or Michael the trader with a hedge fund to registered investment advisor, here's the key, Andrew, that I can no longer trade one strategy, right? I can't spend every waking moment focused on one strategy for one pool or one account. I have to now morph into somebody or something or some entity that's capable of managing multiple strategies and creating a logical portfolio of strategies, and maybe even being a little tactical about which strategies I use and when. And that's where I am today. That's where we are today.
And I understand you're using AI in your trading models as well.
Right. So the whole time I never abandoned my vision of using AI profitably in the financial markets. And I never gave up, and I continued all these years with programming and teaching myself in fits and starts a little bit of Python and everything else. And I just can't be a programmer. I just can't do that and all the other things that I need to do in a life. So what happened was, and I hinted at this earlier, the confluence of the cloud and the AI platforms and the data all coming together in one place. And in 2012, I think 2013, I think I was one of the very, very first clients of a quantitative research group that I'm still with and still partners with, and we've done a lot together. They're based in Atlanta, Georgia. Their name of the group is Lucena Research, and we have been engaged with them since the very beginning in using their technology, their data science, and their machine learning technology, their cloud-based platform, to run multiple experiments and multiple, let's say, hypotheses around investing, and also, more importantly for me, asset allocation using artificial intelligence and machine learning as the backdrop.
Sure. Okay. So before we get further into AI in trading, can we just get a little bit of context about AI in other industries, because it's come a long way. Can you give us some examples of how AI has increased progress in other fields?
Right. I would love to. So all the while during the, let's say, the dark ages again, the dark winter of AI, a few superstars, just super geniuses have come out of that. Jan LeCun is one I have to mention. Also Geoffrey Hinton and also Andrew Ng. These are probably the most famous. I'm sure there's many others that I'm not aware of, and I don't mean to disrespect anybody, but these are the ones that I've followed and that I've emulated as much as I possibly can. Of course, they're geniuses, and I'm not a genius, so I follow them from afar, right? But these are the guys that are running the AI for Facebook, for Baidu, and for Google, okay? And they have been primarily engaged in natural language processing. So this means every single time you or I write a check at the bank, it's read by an AI, it's read by a computer. Thanks to these guys, right? Every time we go to the supermarket and they say sign on the little pad, and you sign and it's instantly okay against your credit card, that's AI. And we can thank these guys for that too. Every time you go on Facebook and somebody it recognizes your face and says, oh, well, you're friends with Michael, and Michael's on Facebook too, and you're both smiling, so you must like each other. That's all AI, and that's all these guys too. It goes on and on and on, right? Obviously, we have Tesla and the almost autonomous vehicles from Google, all AI based. So it's really, truly everywhere, and it's very exciting to watch it explode, literally explode everywhere around us. Do you realize that there are thousands and thousands, if not tens of thousands, of articles written every single day, written by computers, written by AI, not a human being at all?
Wow, I didn't realize that.
Most of the news that you read is written by a computer, especially if it has to do with stocks.
Okay, so we'll get on to the applications of AI in trading. I mean, you've already mentioned a few just before, but what areas of finance do you think hold the biggest potential for machine learning or AI applications?
So AI, so far, okay, here we are in mid to late 2015. So far, most of the artificial intelligence power has been used at the micro scale. It's been extremely high frequency trading, right? These are the guys that are in and out within hundredths of a second. And right, there's been books written about it, Flash Boys and all this stuff. I don't want to talk about that. I never really had the capacity or the intellect or the infrastructure to get involved in that business. I've always tried to find uses of AI where I could maybe find some statistical edge in the several days to several months span, right? So that's always been my view on this thing. Of course, I would love, and I'm sure everybody would love, to find some use of AI that you could get a signal today that would last you for 3 years and you would never have to do anything. But I don't think that that's out there, at least not yet, okay? I should say, Andrew, right now, I need to talk about I need to break this down into 3 pieces.
Sure.
Artificial intelligence gets a lot of press these days, and a lot of negative press. There are basically 3 main divisions or subdivisions of artificial intelligence, okay? There's narrow AI, there's artificial general intelligence, general AI, and then there's this mythical thing called super AI. Most of the articles that we read these days, I love Elon Musk and Stephen Hawking and Bill Gates, all these guys, they're great. I'm not criticizing them at all, but when they've come out and they've said negative or let's say hyperbolic statements about AI, they're talking about super AI, something that doesn't exist yet. So what I'm talking about is narrow AI, literally the lowest level of artificial intelligence that's available. That's where we can get some serious alpha, I believe, in the financial markets right now. There are people like Ben Goertzel who are doing an enormous amount of research in artificial general intelligence, which would be the next level up. And let's say, to use a metaphor, which is the one that he uses, if you can teach a car to drive, if you can teach a computer to drive a car like Google has, that would be narrow AI. But if you could teach that same computer to get out of the car and get on a motorcycle and drive a motorcycle, that would be more like general AI, right? Which is more what a human being can do. A human being can use their understanding and their logic and their experience in one endeavor and transfer it to another pretty seamlessly and be successful. So far, we don't have that in narrow AI as we do in the financial markets. That's where I am, okay?
Okay, so we're really just scratching the surface then.
I believe we are. I believe we are literally still crawling on our hands and knees in this evolution. Yes.
Okay. Before we talk a little bit more about your research, can I just go back to 2 terms you've been using, AI and machine learning? What's the difference between those?
I don't think there is a difference between them. They're kind of used interchangeably. I would say that machine learning may be one of the subsets of artificial intelligence, and it may get us too far off the topic if we go into this, but
Sure.
but basically, when you're talking about artificial intelligence, you're talking about a series of tools that you may use to solve separate riddles or perform separate tasks. In at the highest level, artificial intelligence could be used for regression analysis, classification, clustering, or dimensionality reduction. And these are four huge worlds that you could easily spend your whole life in any one of them and never cross over into the other. So I would say that AI is the highest umbrella over of that, and then machine learning is any of those separate disciplines. For me, and I think for most people in finance, I think that we're mainly looking at regression. We're looking at making predictions of a quantity into the future using an enormous amount of data, whether that data is structured or unstructured, and whether the learning is supervised or unsupervised. So it could be either way.
Okay. So how about we move on now to the research that you've been doing? I know you've kind of talked about it a little bit already, but can you give us a bit more information on the type of application you're seeing today?
Right. For me and for Essex right now, the only profitable running in real time use of artificial intelligence, we have two main outputs here. One is a market neutral long short equity strategy, and another is a tactical asset allocation model. Both of them are driven by genetic algorithms, machine learning, and big data, if you want to call it that. So the most interesting, and the one I could talk about all night tonight if you care, is the market neutral strategy. It's been very exciting for me to be part of this process. It's been a long time of experimentation and pre-production and paper trading, and we're in our 64th week of real-time trading, and it's doing phenomenally well. It's been great.
Is that what you call the tiebreaker, that long-short model?
Yes, exactly. So the tiebreaker is an algorithmic, market-neutral, long-short equity strategy based entirely on machine learning. There's literally zero discretion, zero human input into the process. And what we've done is we've created let's say, genetic algorithm or machine learning process by which we choose the 5 to 10 stocks that we believe are based upon the statistics and the prior success of the algorithms will go up over the next 5 days. And Andrew, that's what we're talking about here. 5 days, 5 trading days, 7 days totally. We enter every single position on Tuesday during trading hours at the New York Stock Exchange. We enter every single position on the following Monday, regardless. Within the week, we have very stringent risk management and position management criteria that we apply to each position. But that's basically the long and short of it is we pick 5 or so longs and 5 or so shorts. We match them up. We optimize them, of course, using a very, very sophisticated portfolio optimization tool that's also embedded in the software. And every single week, we turn the portfolio over 100%. For the past 62 weeks, we've been running at a Sharpe ratio of over 3.3 and a Calamar ratio over 10.
So what type of inputs are you giving this machine learning algorithm?
Everything from fundamental data on individual companies, right? Of course, all the price information that it can take, of all the indicators that it can possibly swallow, and also some non-structured data such as sentiment analysis. We let the computers make up their own minds about what they feel is the most important, what weights to attribute to which inputs. And of course, if they're unsuccessful, we kill them. and we replace them with one that is successful. And that's the nature of artificial intelligence when you're using a genetic algorithm.
Yeah, okay. So how did you decide, or how did you come up with those inputs in the first place?
Well, they're all the ones that any human being would think of that had been in the markets for a long time. And this is another recurring theme from, I remember Andrea, and Larry Williams, and any of the other, I would say, the pantheon of people that you've interviewed on your show here. It has to make sense, right? It has to be logical. Otherwise, you're just data mining. You're just finding relationships that may have been profitable in the past, but will never be profitable in the future. So we make absolutely certain that the computers are looking for and trolling amongst the data set that makes intuitive sense in the first place. And if it's not, first off, you have to be suspicious about it. And secondly, it probably won't do well in out of sample testing.
Okay. Well, let's talk a little bit about that, because I guess that's one of the criticisms of machine learning, is that if you're scouring hundreds and thousands of different data points trying to find something that works, it is essentially a data fishing exercise, and you're likely to come up with something that may not work in the future. So how do you determine that you haven't overfit a strategy to the data?
That's the best question of all, Andrew. And I'm going to cop out here, and I'm going to use a quote from Jan LeCun, who I mentioned earlier, who's sort of like a god to me. And he said that data science is the automatic or semi-automatic extraction of knowledge from data. And later on, he said, now or in the near future, most of the knowledge in the world will be extracted by machines and reside in machines. And I have to say that the first time I heard that, I was just in shock, because it deeply describes, he's not thinking about stocks. He's managing the AI research for Facebook, okay? And he's trying to find a way that computers can see a cat and running and say, that's a cat running, which is an enormous undertaking, maybe more complicated than making money in the markets. I don't know, but that's what he's doing. But back to his quote, and back to your question, now or in the near future, most of the knowledge in the world will be extracted by machines. And I deeply believe that. So when I answer the question, how do I know that we're just not data mining, right? We're not just saying, oh, well, every time it's Tuesday and Tuesday is the number 7, and multiply that by 2 and you should buy. That's the kind of hypothesis that a data mining strictly would come up with. I don't think so. I think we're at the point now where the machines are capable of extracting either automatically, either supervised or unsupervised, from a data set, an enormous data set, true data, true knowledge, and verifiable hypotheses. And what I have found in my recent experimentation with this, at least within a short period of time, say 5 days in the future to 20 days in the future, we can truly extract tradable knowledge from the data set that we have.
Yeah, right. Okay. So I guess another one of the criticisms of machine learning is that some algorithms have, some inherent randomness in them that makes it almost impossible to reproduce results. So what would you say to people who say that you can't trade a process that isn't deterministic?
I love the question. Philosophically, I love the question. I would say that there's so many people out there who have made pulled an enormous amount of money out of the markets, that it's obviously not true, right? That it can't all be random all the time. That there has to be a way. What I would say from my perspective, Andrew, is this: that there are small places in the markets where you have maybe most of the time it's random, maybe most of the time it's non-deterministic, maybe most of the time it's completely entropy or whatever. But there are times when it is structured. And since I've always been in my heart a trend follower, I've always looked for those places where it's definable that there is a structured trend happening, whether it's up or down, or sideways. Okay, it could be sideways. There's three possible states of the market, and I'm happy with any one as long as I'm on the right side of it. So what I would say is that with supercomputers and huge, enormous data sets and either supervised or unsupervised learning, we are capable now, right now, and even more so in the future, of extracting from those data sets those places where there is a statistical edge in the future outcome. In other words, I don't like to use the word prediction too much, but it's really statistical edge, right? If I know that I'm right, if I know that if I follow this pattern 65% of the time and I have the right money management overlaid on top of that, I'll be okay. We'll be fine. Many of the greatest trend followers in the world were batting 350 or 400 in the days when they were being successful. So I don't see why we can't use huge data sets and machine learning, come up with probabilities in the 65 or even 58%. That's where we're running right now, 58, and it's fine. It's great.
Okay. I just want to jump back to a statement you made earlier that AI seems to work best for the shorter time frames. Why do you think it doesn't work so well for the longer time frames?
I have friends who are working on longer term time frames, and we are too. All I can say, Andrew, is that it's probably a function of the markets changing states so often. That's my guess. Because even though we can have a grand super cycle where U.S. stocks go up for 6 years in a row, right? So, 09, 10 through 15, they're up, 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 up. Okay, we've had a very short, sharp downdraft here, but you could still argue that equities go through a grand super cycle, and that grand super cycle may be picked up by AI. It may not. I just don't know. What I do know is that for the short run, using the processing power that we have and the tools that we have, I have found that the greatest, say, profitably tradable systems are in a shorter time horizon, say definitely less than 20 days. And as I said earlier, many people are talking in the hundreds of milliseconds and with their AI.
Yeah, so I guess when you're working at the hedge fund, you made a stack of money doing trend following strategies using TradeStation code, which is, I imagine nowhere near as complicated as machine learning. Do you think perhaps that machine learning or AI isn't the right tool for a longer term approach?
For now, yes, I would say yes. Although again, I'm not in on the I mean, there are people using quantum computers. Okay, they may be getting something out there that I'm not aware of, and I wouldn't be surprised if they were. But as far as I know, and as far as I've learned from all the people that I've emulated in my life, growing up and trying to teach myself how to be a trader, etc. The simpler, the better is definitely a good way to look at it.
Yeah. Did you want to have a quick chat about event studies?
Sure.
Okay, so I read an article where that you wrote saying that you were doing some work on event studies. Can you explain a little bit about what that is? So
the original event study paper was written in the 1990s, I think. I'm not being fair to the person that wrote it, but essentially what it says is that perhaps there's a way to derive alpha from trading stocks after an event occurs. So for example, let's say that Apple goes down 4 or 5 days in a row, and then they have their earnings, and after that earnings, they go up on average 3% over the next 5 trading days after the earnings. That the event would be the earnings, and the pattern would be the down prior and the up after. That's the very, very basic event study. Machines are extremely good at deriving event studies from the data. whether or not the event is a Friday or an earnings or let's say the retirement of a CEO. Any of these things can be described as an event. And event studies are actually a fundamental part of the tiebreaker strategy that we mentioned before. Oftentimes the equities that are chosen for purchase or for sale in that strategy are based upon a prior event study.
Right, okay. So I guess it depends the type of events that you're looking at, but do you find that you get enough of a sample size for it to be accurate?
Yeah, always thousands, yes.
Okay, excellent. All right, just a couple more questions and then we'll start to wrap up. Where do you see the future of trading heading?
Well, I don't think many of my compatriots would like to agree with me on this one, but I'm just going to say it anyway. I believe that it is an inexorable trend that the machines will take over an ever increasing part of the financial management landscape. And personally, I believe that that's a great thing for everybody. I believe that the less animal instincts we have in the process and the less emotion and the less tired money managers and the less burnt out testosterone toxic traders we have, the better things will be for everybody. So I see the future as being almost completely taken over by machines. I do.
Okay, and what about for a trader who wanted to get started into AI or machine learning? How would you recommend they get started?
I think that the basics will still apply no matter what, right? So the markets will move in long pulls, or they'll be in one of three states. They'll be an uptrend, downtrend, or sideways. And there's no reason in the world, even if the computers are making most of the big decisions, there's no reason in the world why a small or a new trader can't find somewhere in this world to carve out a niche and be disciplined about it and be dispassionate and quantitative and find a way to pull some money out of it. Again, I've always focused on trend following, but that's not the only way to make money in these markets, as we all know. You can hear from your other guests. There's plenty of counter trend. There's seasonal trends. There's buy on Monday on the close and sell on Wednesday on the open kind of trades that are all over the place, and they're all legitimate and they're all honorable ways of making a living.
All right, and okay, so I think we'll just start wrapping this up with some quick closing questions.
Sure.
So what's the biggest lesson you've learned through trading?
To be objective, to realize that no matter what, ultimately it comes down to a scientific process, and it comes down to the ability to be dispassionate and to put your own let's say belief system or your own biases and your especially your own blind spots to the side, and be dispassionate and objective about what you're doing, and to see it as no more than a quantitative exercise.
Yeah, okay. This one's probably a little bit related as well, but what do you think is the most important attribute a trader needs to become successful?
Absolutely, it's objectivity. For me, it's objectivity. You might say discipline or a lot of other attributes, but for me, it's always come down to that. I have a quote. It's actually by a writer. So the quote is by Philip K. Dick, and he said, "Reality is that which, when you stop believing in it, doesn't go away." And for me, that's a very important part of the whole trading experience. We have to focus on all the things that don't go away when we stop believing in it. Too often, people enter the market for whatever their own reason is. They like the action, they like to gamble, they believe, they love their iPhone 6, so they're going to buy Apple, whatever. You have to separate your belief system from the reality of the market that you're in. If you can do that, you have at least the beginning of the fundamental undercurrent of being successful. On top of that, you need good money management. And if you have both of them together, I think you can be successful no matter what.
Yep, that's some great advice. Thanks, Michael. What about, do you have a favorite trading book?
Favorite trading book? I would say, oh gosh, there's so many coming to my mind. I would have to go with Trading Systems That Work. That was one of my favorites. I don't remember the author, but Trading Systems That Work is definitely one. I have Artificial Intelligence in the Capital Markets by Friedman, Klein, and Lederman on my desk right now, but it's about 20 years old, so I can't recommend that one anymore. But
yeah, what about, is there an online resource that you could recommend people go to have a look at more into AI or machine learning?
What I've done is I subscribe to all of the Twitter feeds on this subject, and there are many of them, and yours is one of them, okay? So I would recommend for people who are looking to get into this side of the trading business, or to find a way to incorporate big data or machine learning into their trading, to go onto Twitter or Facebook and just do a few simple searches on any of those buzzwords: machine learning, AI in finance, quantitative trading. There are many groups out there, and they're all very, very valuable. I couldn't give you a short list because it would have to be too long, and I would be unfair to somebody. But they're out there and they're great, and there are many, and there are many of them that are communities where they just share information for free. It's fantastic, truly.
Yeah, cool. And so if someone wanted to get in touch with you, what would be the best way for them to do that?
Well, I would love to communicate with anybody that was interested in what I said tonight. My email is michael@essex.us.com. My company is Essex Asset Management in Vero Beach, Florida. If you do a Google search on Michael Himmel, Essex, you'll find me immediately. That's the best way to get in touch with me. Sure.
Okay, great. So thanks so much for chatting with us today, Michael. Is there anything else that you'd like to mention before we wrap up today?
Just that I truly appreciate your work, Andrew. I think you've got a great site. I think you've got a great program here. And again, I thank you for all of us that have learned something from all the people that have taken the time to be interviewed by you. And as I said, many of them are to me part of the pantheon of trading. And I really appreciate it, and I'm sure everybody else does too.
Oh, fantastic. Thanks for the kind words, Michael. So thanks for spending time with us today and being so willing to share your knowledge and experience with us. And I wish you all the best for the future. Cheers.
Thanks, Andrew. Talk to you soon. Bye.
Thanks, bye. Thanks to Michael for the chat this week. Having had very little exposure to AI and limited experience with machine learning, I found the chat really interesting. One particular tip I like, which can be applied to all trading styles, is the selection of datasets. Michael mentioned that the selection of datasets is critical. He selected datasets which make logical sense, so even though he's allowing an algorithm to determine the weighting of the datasets, he is making sure the computers are looking through data that makes intuitive sense. These principles can be applied to trading styles outside of AI and machine learning too. Does your model make sense? Is it logical? Or have you just mined the data to find something that appears to work in the past but has very little chance to work in the future? If you want to get more information about this episode, head over to the show notes, bettersystemtrader.com/23 for links to additional content. In next week's episode, we're talking to the only trading psychologist featured in Jack Schwager's book, Market Wizards. He's helped thousands of people around the world to become better traders, and he shares his knowledge with us. Plus, he has a special offer for Better System Trader listeners, so make sure you don't miss out on that one. Anyway, I hope you enjoyed the chat with Michael this week. Thanks for listening to Better System Trader, and I'll catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.